Hello, everyone. Today on the Final Bar, I'm joined by John Gagliardi from Fidelity. We'll talk about some of the charts that are top of mind for him. We'll also review this choppy market environment. One of my guests last week or the week before, I forget when, called this the choppy slop phase or sloppy chop. I forget which one we did, but either one of those is probably a fair way to describe what we're seeing here. A lot of fluctuations, very much a defensive feel to the tape with utilities and real estate, number 1 and 2. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment, break down the market activity using the power of StockCharts, using data visualization techniques, the technical analysis toolkit to better quantify investor behavior, better understand market dynamics, and anticipate what may be coming next. Certainly I've talked in recent weeks and really in recent months about this overall transition of sorts of the market to a period of elevated uncertainty, elevated volatility. We're seeing the VIX above 30 and sort of remaining there here recently. And certainly there are plenty of narratives out there. There are geopolitical challenges we're running into, of course, and just how investors are anticipating and processing all the news flow that we get. We have this minor issue called the Federal Reserve meeting coming up here in the next couple of weeks with certainly the potential to reset markets very, very quickly. At the end of the day, I would argue this is an ideal time to be thinking about the charts and focusing on key levels, what I would call lines in the sand, right? At which point, given your position, given your thesis, given your overall call, at what point would you agree that you're wrong? What level or what signal or what indication would suggest either you're not in the right positions or not in the right investment thesis? It's an important time to do that now as you have sort of this choppy transitional phase in the markets. We have great guests on the show. I'm excited. John Gagliardi is going to join us for the first time today, joining us from Fidelity. Other guests we have coming up next week on Tuesday, the 8th, we have Matt Tuttle. Matt's the founder of Tuttle Capital Management. He's the manager of some ETFs like the SPAC ETF, the Short Arc Innovation Fund ETF, and others. So be interested to hear his take on things. On Wednesday, the 9th, we have Jonathan Krinsky from Baycrest Partners joining us from New York. Also, our latest episode of The Pitch is coming up next week in celebration of Women's History Month. It's going to be all women commentators, and our host is going to be Erin Swenlin from DecisionPoint.com. She's going to be joined by Danielle Shea from Simpler Trading, Mary Ellen McGonigal, who's a familiar name and face to many of you, and Mish Schneider, co-founder of the Market Gauge Group. All of them really knowledgeable experts, traders, money managers, sharing with you, pitching their ideas. Go to StockCharts.com/thepitch for more information on that event. Let's continue on with our market recap, breaking some of the activity that we're seeing in the market today from a technical perspective. This was a choppy day by any definition. Earlier in the day, as the S&P is sort of right at that zero line, I'm looking over at the sector leadership and saw a very defensive feel to things. So I'm not surprised that things have sort of rolled over. The S&P settled in toward the lows of the day, down about 0.5%, right around 4360. Utilities and real estate and then consumer staples, the three top sectors, and some of our sort of growthy previous leadership sectors like consumer discretionary, like technology, at the bottom of the list, sort of leading the move to the downside. The NASDAQ composite down 1.5%, almost tripling the down day of the S&P 500 on a percentage basis. Mid caps and small caps both down as well, even more than the large cap S&P 500 index. The VIX is down just a bit, but it's still remaining above 30. So that 30 level we'll look at a little bit later in our segment on market sentiment indicators. We'll start with the VIX, and you'll see how that's relatively high relative to where we've been so far this year, but also for the last year or so. Looking at some other asset classes here very quickly, the TLT, which we often use as a proxy for bond prices, up about 1% today. 10-year yields down about 1%, down to 184. The 30-year yield down around 223. Dollar index up a little bit. And I've talked with some of my guests recently about stronger versus weaker dollar. It's one of those things that's sort of in the background and can provide a huge tailwind and or headwind to certain asset classes, to certain equities, and to certain themes. So certainly pay attention to the dollar index, strengthening today from yesterday. Commodities continuing overall to push higher, although energy prices were off a bit, sort of a mixed bag altogether. But the DBC, which is the main commodity ETF that we follow, ended the day about 1%. Gold continuing to push higher as well. We've highlighted some of those mining stocks and others. Yesterday, if you missed it, we did a deep dive on the materials sector. We talked about steel and aluminum and commodity chemicals, specialty chemicals, and gold and mining stocks. So go to our on-demand platform, StockChartsTV.com, if you missed that one. Finally, cryptocurrencies, all in the red. We're looking at the 10 most liquid coins that we track. Bitcoin down almost 5%, Ether down over 5%. Ethereum remaining, below 3,000, which is one of those key levels. Traded up to it yesterday and not really able to complete the transition above there. Now coming off another 200 points lower from that point. Bitcoin now back below 42,000, and so really starting to roll over. You're seeing a flight away from cryptocurrencies as an asset class overall here recently. Let's look at a chart of the S&P 500 and talk about how things have played out. You know, I'm rarely surprised when sort of significant numbers tend to repeat themselves. 4,400 is a level we've talked about a number of times, and we first talked about it back here in July of last year when the S&P hit 4,400 and then pulled back about 3.5%, 4%, which is not that big of a drawdown. But for 2021, that was actually one of the deepest drawdowns of the year. That was huge, being down 3 to 4%, right? That was sort of one of the numerous sort of brief pauses in the uptrend before the uptrend resumed. From there, 4,400 has been sort of a magnet price of sorts. We've bounced around there from above and from below a number of times. So we closed there actually in mid-February before bouncing back up to the 200-day. We're now trading up to 4,400, so where we opened today, but then sold off from that open. So, I talked a lot yesterday with my guest, Craig Johnson, about how to label this current market environment. I stand by the thesis that this is a bear market rally, only because the longer-term trends that we've been looking at, the longer-term signals, measures of market breadth, and other things would tell us that the markets are still in a distribution phase. Just the fact that the stock market keeps making, and again, the major indexes here, the S&P, the NASDAQ, make lower highs and lower lows. When that stops happening, when we stop making lower lows on the price swings, I will agree to stop at least so loudly calling this a bear market rally. We'll talk about relabeling it a little bit. But at this point, you have to take a step back, I think, and look at the trend. This is a market which continues to push downwards. You're seeing selling pressure materialize in the form of a lot of stocks being unable to hold support levels, and bounces like the one we're seeing fail to eclipse the previous swing high. So overall, I think still showing some signs of deterioration. Momentum showing pretty negative as well. Let's go over, when we talk about price momentum, I'm immediately then thinking about market breadth indicators, and we're going to dig a little deeper into the sentiment readings here, but I just wanted to update on some of the breadth characteristics that describe it. We talked yesterday about the cumulative advanced decline lines, and sorry for whipping around charts here, but the cumulative advanced decline lines, most of them have undercut their lows from the last 6 weeks. The only one that has not really is the S&P advanced decline line, which is still holding above its December low, just barely. We'll see what happens today, if that's enough to push it below there, but the other three have all now undercut their lows from December, and I would argue they're in a downtrend as well. And when I think about what would tell me that this overall corrective pattern is over, something like the breadth indicators, the cumulative advanced decline lines, turning back positive, right? Turning back and rotating in an uptrend. That would certainly be one of those things that would catch my eye. When you look at the percent of stocks above key moving averages, here we're looking at the S&P 500 members only, and you can see as of yesterday's close, 47% of the S&P above their 200-day, which means, just like the S&P itself, over half of the S&P members are currently below their 200-day moving average. You take that back to, April of last year, is almost 100% of the index above their 200-day. Here in November, where I would argue was the top for all intents and purposes in terms of when a lot of the breadth indicators started to roll over, it was still almost 80% of the index above their 200-day. In January, when the S&P made its most recent all-time high, it was about 75%, and now we're down to 47%. So you can see the steady decline of more and more S&P members breaking down through their 200-day moving average. And even though we're seeing a viable bounce of sorts, a jump off of the last swing low, it's not enough that individual names are recovering the 200-day, which is sort of a key long-term barometer. It's about 1 in 3 S&P members above their 50-day moving average, and that's the green series on the bottom. So, when both of these remain below the 50% line, which is sort of this, pink horizontal line, it tells me to not be too excited about the market environment, because getting above 50% would tell you that there's an accumulation phase. Stocks are able to regain a key moving average and stay there, and we're not necessarily seeing that yet. Final thing, just to finish off our market recap, I would look at the new highs and new lows. I was putting out a chart on social media earlier today on Twitter, focusing, it's what I call the chart, and it's just a summary of some of the key technical indications that I would look at for the broad market. And one of them was looking at new highs and new lows. You can see there is obviously an influx of new lows, new 52-week lows. So these are stocks obviously pretty far off of their 52-week high if they're making a 52-week low. And there's a pretty decent amount there the last week in February, really coming off there. From there, you've seen obviously a lot of them lighten up, because most stocks made a new low about a week or so ago, and now bouncing higher, you're starting to see an increase in new highs. And again, just thinking as we're in a downtrend, and what would tell me that downtrend may be over, an expansion in new highs is often a really bullish indication. It tells you stocks are able to recover and push to new highs. You need leadership to drive the market higher. Not necessarily seeing enough of that yet, but this could be a chart to watch to read that move in the markets. We need to take a quick commercial break. We'll be back with today's guest, John Gagliardi. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down the market environment using the power of technical analysis, using the technical toolkit to better understand the market dynamics. We're going to get to today's guest, John Gagliardi, here in a few moments. First, a couple quick announcements. First off, we love to hear from you. Feedback on our show, on our host, on our guests, all of that is super welcome, but we especially like to hear questions you're creating as you're analyzing your own charts. As you're using the technical toolkit, using stock charts, looking at market history, what can we help you answer? Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. All of our great guest appearances like John Gagliardi, Craig Johnson, and such a knowledgeable guest we're able to bring through. Also special events like Larry Williams' market update last week, Martin Pring's market outlook in January, special episodes of The Pitch, and much more. Go to StockChartsTV.com or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest, John Gagliardi. John's a regional brokerage consultant with Fidelity, former colleague of mine from my Fidelity days. And John, it's good to see you and welcome to the show.
Great to be on. A big fan. So it's awesome to go from being a fan to hopping on the show. Awesome.
No, I appreciate you sharing a couple minutes and sharing some expertise with us, John. Now, you asked to look at a couple sectors over time. We're going to start with industrials, which is an area of the market that really has not been participating a whole lot. We're looking at the XLI. What are you seeing?
Everyone's looking for the canary in the coal mine, because last week was that a low or was it the low? And everyone's looking at the commodity trade. So everyone's focused in on metals, mining, and oil. But if industrials aren't going, why do we need metals and mining? If industrials aren't going, what are we shipping? And you can see on the right side of the chart there, we had a little bit of an oops. We broke through. We collapsed. And we quickly got a recovery. And that's okay. And a lot like your advanced decline line, right? We start to look at the smaller bits of data. And if we look down at relative strength, now everyone loves to look at relative strength above 30, below 70. What I like is 50. If it's above 50, it's in the positive. It's going in the right direction. But if it's below 50, and this is still below 50, I have to wonder, is this a bear story or a bull story? And lastly, of course, can't leave out MACD. You can't leave out the Big Mac. And this is clearly negative, negative, negative. And if we zip below that zero line, I can't see anyone saying there's a bull story here that's unfolding. I've got every divergence. By the way, there's a 5-year weekly. And on the 5-year weekly, you know, it's an intermediate time frame, or I think it's 5-year weekly. Yep, weekly. So the good thing is we're looking at this not as a long-term buy and hold investor, but not as a day trader either. This is right in the sweet spot. And I want someone to tell me why I should go long commodities if industrials fail. If industrials fail, you might have another swipe at commodities at a much better price.
Interesting point. Your second chart is looking at the real estate ETF, IYR. REITs, one of the top performing sectors today on a fairly defensive day. We're looking long term, going back to almost 2000 here. What's your take on real estate?
So, in 2021, 3 sectors all broke out, one behind the other. It was home builders, real estate, and banks. And it kind of makes sense. You build a home, you sell the house, and you go to the bank. It kind of happens in that order in life, and it happened in that order in the chart. So real estate is in the middle of this. Now, this is IYR, so it's not just REITs, not just real estate investment trusts. It's also the brokers. It's the whole real estate industry, and it's the longest running ETF in the space. And we were playing with the chart beforehand, and you could see it only goes back to 2000. The key is 2007. 2007, this chart was ripping. This was the market. The market was driven by real estate and banks. And it had the biggest collapse we've seen since the dot-com bubble. This is the collapse that everyone should still be stinging from this if you were investing back in 2007. And it spent 14 years basing. And, we're old school guys, Dave. The wider the base, the higher the space. And we got a full-fledged breakout in 2021. So while everything is pulling back, this one might be just pulling back to a base, which to me, that's like ground zero, right? If it's going to be an uptrend, it's got to hold the base. And if that holds, you could have the best entry on one of the newest breakouts that we've seen in a decade.
I love the long-term perspective on this and just seeing, it's so easy to get caught up in what I call the flickering ticks, the short-term movements of the market. When you look longer term, you can see what a broad basis was, right? How long it took for real estate to get to new highs and as it rotates up. We only have about a minute left, John, but as you're thinking about the overall market environment, as you're thinking about the S&P that's, bounced off of a recent swing low, do you look at this chart with a sense of optimism or pessimism in terms of the overall trend? Are you seeing things that concern you? Or are you seeing opportunities to reset as a long-term investor? How are you interpreting this move?
So last Thursday haunts me because I don't want to miss the low. If the 10% pullback was the low, but I think about human nature, and when the market's down 10%, people take out their checkbook and they bought the heck out of the market, getting a nice, sweet 10% pullback. And there's nothing wrong with that. 50 years from now, 100 years from now, there's still going to be the S&P, and you still will have gotten a discount. But if the market is doing what it seems to do, which is lower lows and lower highs, we can still go a lot lower. And I'm not going to cross that Rubicon until I see relative strength breaking above 50, MACD turning positive. I want everything screaming at me, you're missing it. And I'm not feeling that yet.
I love that. And you mentioned the RSI getting above 50. I can't help but point out that we're not seeing that on the S&P just yet. John, listen, it is so good to see you. I really appreciate you coming on the show here. We'll love to have you back again. But until then, stay safe and be well there, okay?
Anytime.
That's John Gagliardi. John's a regional brokerage consultant with Fidelity Investments and joining us. I love that take. Just the simple idea of looking at longer term charts and focusing on price momentum. And I love it. It's so interesting. We're looking at industrials. We're talking about the RSI and how it's below 50. You look at the S&P and you get a clear sense, or you would get a clear sense of when that trend may be shifting, as I think he pretty clearly said it. Not necessarily seeing that yet. Great take there from John Gagliardi. Let's continue on today's show with our next segment, Getting Sentimental. What we love to do is a lot of the weekly sentiment data is updated Wednesday into Thursday. So Thursday is a really good day to take a look at some of the sentiment indicators and what they're telling us. We usually have about 3 parts to this. We'll start with volatility, so we'll look at a chart of the VIX. The second piece is looking at some survey data. So look at the AAII survey. We'll look at the NAAIM exposure index. RIDEX flows are all information based on survey and positioning data. Finally, put-call ratios, which can be interesting as well. When we look at the VIX, we've talked about how 2022 so far has been a year of uncertainty, elevated uncertainty, and elevated volatility. And those two tend to move together, right? More uncertain, more anxiety, if you will, about the market, the higher volatility tends to be. That's why the VIX is often termed the fear gauge or the fear index, because it's a way of measuring, fear, right? The more volatile, the more uncertain, the more anxious, the more volatile markets tend to be. The VIX is just above 30, and you'll notice 2 other times in the last 3 months where we've gotten a VIX above 30. One was in late November, early December of last year, which, as you can see on the chart, pretty viable dip there. That was that last pullback in 2021. The next time we got above 30 was here in late January, and again, get a bit of a viable dip. So we have a VIX above 30 again. We have so far a bit of a viable dip, and the question is it a long-term buy opportunity, or is it more of a bounce, a tradable bounce within a long-term downtrend? The challenge I have with thinking of the VIX as being bound, right? Saying, all right, all I need to do is wait for the VIX to hit 30, and then that's my obvious buy signal. The problem is it's not bound on the upper end. The VIX can and certainly has gone much, much higher than that. Look back in February, March of 2020, you can see a perfect example. If you had bought when the VIX was the highest level it was in the last 12 months, you would have bought here in late February, which was this first bounce before the big leg lower when the S&P made another 3 weeks of lower lows. So overall, the fact that the volatility is elevated is certainly noteworthy. I don't see enough evidence on a chart like this to say that this is an obvious buyable dip compared to the previous buys, only because we may just be entering a stretch where the VIX is a little more elevated. I point you back to late 2020 when the market was in another transition phase, sort of the September, October of 2020 period. The VIX routinely remained above 30 for a couple weeks at a time. And in the end, while those ended up being some decent buying opportunities, that was in the context of a longer uptrend. And again, the VIX got a lot higher than 30 before all was said and done. So volatility is elevated. The trend in volatility also seems to be positive. And even as the S&P is bouncing higher, it's worth noting the VIX is not coming off a ton, right? Compare that to January, where the market rallied, the volatility came off very quickly. We're seeing volatility stay elevated. I think the VIX remaining above 30 is a great measurement of ongoing uncertainty in the markets. The AAII survey is a survey of individual investors. Once a week, they're asked, are you bullish, bearish, or neutral on stocks? You can see what's happened in the last couple of weeks. The level of bullishness has actually increased. So as the S&P's chopped around sort of this 43 to 4,400 range, the bullishness has increased. The bearishness has actually decreased. You're down from upper 40s down to lower 40s, right around 41, 42%. Bears. So overall, bears still outweighing bulls, but it's the closest, or it's the narrowest spread between the two that we've seen in the last couple months, really year to date almost. So overall, you're seeing increased bullishness. Clearly because of the bounce in stocks, you're getting some belief in there. And as I mentioned before, I think bear market rallies in a lot of ways are the toughest environment because they are super seductive. When the market does that V bottom and starts to rally, it is really easy to get sucked in with the idea that the low may be in. I often remind people, especially longer-term investors, take some time and wait for a higher low. A lot of times that can be a confirmation that things are rotating higher. This next chart is a really interesting one. This is the NAAIM Exposure Index. We're looking at the current level, which is around 30%. And this is basically a survey of active money managers. What is your allocation to equities? And you can say 100 or 200% long, 100 or 200% short even to determine what your overall weighting is. And right now it's netting out to about a 30% level. This is the lowest that we've seen in almost 2 years, right? The last time we were down in the 30% range, 2 previous times in the last couple years. One was in late February, early March of 2020. So again, it was in the beginning phases of a much deeper drawdown. You also saw same level here in November of 2018. And again, that's before the big leg down that you saw in December. The times before that we've been below 30% are in late 2015, early 2016, which was the second low. The first one was back here in 2015. And again, the time when we went below 30% was here, well before the low was in. So what concerns me about this indicator coming down so much is it tells you active money managers that participate in that NAAIM survey are at the lowest level of exposure to equities that they've been since since the correction in February, March of 2020. And most of the time when we've gotten to this level, we're not anywhere near the end of that corrective period. We're more early stages of that. That's another sort of data point that concerns me about this current environment. Bottom, you have the RIDEX flows, and this is basically saying within the RIDEX family are investors in the more offense or defensive side of the RIDEX family. They were the most bulled up in December. You can see November and December, the line was going higher, and this is inverted, so it's more in line with overall positioning. Very high on this chart means more bullish positioning. It's rotated lower in a pretty big way, which tells you year to date, in the RIDEX family, investors are getting more and more in the cash and money market type part of that fund family. Very briefly to finish off the put call ratios, I don't have a lot to add to this. I think it's been covered pretty much with the VIX and with the survey data. I would note it's sort of elevated but not extreme signaling right now from the options market. And again, it had been higher a couple weeks ago, or about a week ago, in both of those cases. In this way, I'm actually smoothing out the data in pink. That's a 5-day average of the raw put call ratios, which can actually be pretty noisy. So at this point, elevated but not at an extreme. January was a more higher extreme in both cases. That's our look at sentiment. We need to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the utility sector. I talked with my guest today, John Gagliardi. It's a really good take on real estate and thinking about the long-term thesis there. I'm looking at utilities, which is the number 1 sector today, with real estate not far behind. What concerns me about this chart is the fact that it's starting to work. You're seeing utilities rotate to the upside, and most concerning for me is the fact that the relative strength on utilities is improving. It's making a 6-month relative high, if not even more, maybe a 9 or 10-month relative high. The thing that concerns me about that is, generally speaking, you own utilities when you want to not own other stuff. When you're trying to be defensive and you're trying to gain some income and ride out periods of market turmoil, you go to something like utilities, and we're seeing that sector rotate higher, particularly a day like today, which was pretty choppy, and the relative strength continues to improve. That tells me, or indicates, that institutions are starting to own more and more utilities, which in general, not the most bullish signal I could come up with. Second chart, we talked in our segment Getting Sentimental about some of the commonly used sentiment indicators that we follow. The NAAIM Exposure Index is a key one. When I talk about the potential for further downside, this is one of those charts that comes to mind. When the NAAIM Exposure Index has gone from over 100% in November to almost 30% here just a couple months later, that shows you how much of a rotation there has been with money managers getting more defensive. And it aligns very closely, not with bottoms in the market, but with earlier parts of those downward moves. And that indicates to me, at least, there's some likelihood of further downside to be had in this current market corrective period. Finally, let's finish the show on a high note. Why not? We have a couple names that are bouncing higher. Stocks like Kroger rotating to the upside. I'll highlight Best Buy today. Overall, consumer discretionary is certainly not the best sector I could come up with, and I haven't really highlighted a lot of consumer names, and certainly on an allocation perspective, because you're seeing so much strength in other sectors, things like materials, things like REITs, utilities even, consumer staples doing much better than consumer discretionary in recent months. But I have to recognize and acknowledge a stock that's gapping higher. What's interesting about Best Buy right now is it gapped right up to the 200-day moving average. This is an important one because it gapped right above 105, so the high from January is now the low from today. If you get long a name like this, I think an area like 105, the upper end of that gap or the lower end of this current move could be a really important level to watch. And also, can it get above the 200-day moving average and stay there? That's a key question. Folks, that's our show for today. Special thank you to John Gagliardi joining us from Fidelity. Really appreciate his perspective. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.